All right. So if you're buying a home in Texas, all right, right now, you're probably worried about interest rates, payments, whether your credit is going to be strong enough to get approved. But today we're going to show how you can fix all of that. My name is Mike Price, the hybrid agent, one of the only realtors in Texas that is helping people purchase a home by saving more money than the traditional realtor or agent by giving you up to half of my commission to help you buy down your interest rate, go towards your closing costs, and make sure you just get an overall better deal. All right. Today, what we're going to do is I'm joined by the credit repair king himself, Mr. Credit Solutions, a true expert in helping people rebuild, restore, raise their credit score so that they can qualify for the best mortgage possible, a home, all kinds of loans, things of that nature. All right. So the real problem that people are facing today is the high interest rates and the high payments. I mean, everybody complains about interest rates are too high and they're scared. A lot of people get worried about their credit score because they've had a few hiccups down the road here or there, and people just being denied or overpaying just because they don't have the right guidance. And with traditional home buying, it fails a lot of consumers because of their credit score may be too low, or the person doing the loan just doesn't know how to get behind that. And we're also going to talk about why the hybrid agent program exists. And that's just to give buyers leverage and savings.
Yeah.
All right. So what we're going to do today right now, I just want to go ahead and introduce Chris. Chris is on here. Go ahead and ask him a few questions about how he got into the credit industry. Chris, you ready?
Oh, yeah.
All right.
Locked in. Go.
Okay, man. First question. Tell us, how'd you get started in credit repair?
Man, great question. Connecting with what you're talking about, the challenges that you're facing or loan officers face with credit. I myself used to be a loan officer for almost 8 years. And my number one reason why I couldn't get clients into a home was credit. As a kid, I was always intrigued how credit worked. There was family members who couldn't buy a car. And, as a kid, that always stuck in my head, and I wanted to learn and deep down inside, figure it out. As a loan officer, like I said, I see many of my clients that were getting turned down. So I started to look for ways myself, trial and error, and took a deep dive and what I could do to get my clients qualified. And what made me started the company was when I was living in Austin. There was working in Austin, and there was a credit repair company that was bringing us breakfast and telling us about how they can help our clients and so forth. And we ran into the typical what a lot of loan officers may see unfortunately with credit repair companies, where you never hear back from them. And I thought to myself, man, this could be a great thing for my clients if this what really had worked. So when you put all that together, being intrigued as when I was young to being a loan officer and experience it, I started to really just take off from there. It took me about 3 years to learn the credit by trial and error for myself and with close family and so forth. So this all started in 2011. Fast forward till today, when we serviced over 20,000 clients, where people were wanting to buy a home, primarily people that wanted to start a business, personal guarantee credit, or even buy a vehicle. We love what we've done, and one thing I do want to add, we like to pride ourselves that we are credit counselors, not credit repair. The credit repair industry, as you know, does have a bad rep, and we're not so much, we do credit repair, we happen to excel in it, but we take pride in teaching people how credit works.
Okay, all right. 2011, dude, 14 years in credit repair?
Yes, sir. It's come by like that, it feels like.
That's a long time. All right, now with that being said, man, tell me, what mistakes do most consumers make that hurt their credit score the most?
Oh, man, I can't give one, but I'll give two parts. The number one thing that I see and when customers join our program is that they don't understand that utilization, even though they have a good credit score, is the second highest factor of their score, which is 30%. So what I mean by utilization is the credit cards. Our biggest battle is dealing and getting customers out of the habit of using utilization through credit cards, because it lowers their score by 30%. That's the thing that I see when customers join our program. Now, outside of that, the number one thing I see is people paying off collections. Every year during income tax season, everybody sees something on Instagram or YouTube that you can do a pay per delete. there's different ways that you have to address the paper delete could work, but paying off collections removes the balance, but not the payment, the payment status, which is collection at 35% of the score. That is the number one thing that I see with people that are outside of our program.
Yeah, no, man, we get that a lot. People are like, man, I got this, I'm just pay off, and I'm like, wait a minute, let me do something. Let me check a look before you just go out here and start randomly paying stuff off, and then don't have money to close your deal.
And it does help in some instances. Like if I know there's a medical company in West Texas that they do a pay per delete where they'll remove a medical bill or even like a utility bill. You have to have that in writing for it to stand. But what they're being, from what I found, they're very deceptive. What they mean, they're going to remove the balance, but not the collection, because they have to report your payment history to the bureaus.
Yeah. So basically, don't just run out there and be like, hey, I got to pay per delete, because they may not delete it. They'll delete the balance, and now you still got this on your credit report.
Yeah, exactly. And then also, like, if that was the case, credit service companies like myself wouldn't be in business, because everybody could just pay off all their collection to have a great score again. So it's not the case. So.
Okay. All right, man. Here's another one, man. Give me, what's a big myth about credit that people need to stop believing? What's something that a lot of people come to you and say, well, I heard this, and you got to tell them that, hey, it's not true.
Oh, well, that was, I guess I touched on that earlier. It was paying off the collections. That's a big myth. But also, I guess there's another one, is that people believe that having multiple like credit cards will help their credit score. There is a good healthy mix, which is 10% of their credit score. And what happens is people will get one credit card. They'll have it for, let's say, 3 years. Their length of credit history is very good. And then they think that, well, you need to have multiple credit cards to have a better score. What they don't realize is that they're lowering their length of credit history, and that is lowering the score by 15%. And so that's a big myth of having multiple credit cards to have a good score. I've seen many clients in our program that only have one, and they've had it on their credit for like 10 years, and they have exceptional scores. So that's a myth of having multiple credit cards and open up more accounts, because you're going to add more inquiries to your file. You're going to lower your length of credit history. And then what we talked about, the utilization. Most people and unfortunately, when they're given a credit card, their habit and from soliciting or marketing to use it. And now we have to coach them on coming up with the money, coming up with the budget to pay down the credit card usage that they accumulated. So.
Okay. Now you touched on something real quick. You said something about having the credit mix of not just credit cards and other stuff. I mean, I just experienced this about a month ago. I paid off my car, my credit score went down. I'm like, this don't make no sense, and it just kind of sucks, because now I don't have any installment loans out there. The house, 1 or 2 credit cards and no installment. I'm like, shoot, I thought I was doing good by paying off the car, but my freaking score went down.
Yeah. And I experienced that myself. Whenever I was floating in the 820s, 830s, I wanted the perfect score, 850. And what it came down to was a healthy mix. I didn't have an active mortgage on my credit report. So there's good and bad. I tell customers, well, what you're going to do to your score, I guess that's another myth we can add on to it, is when you pay off a car, good. I think that you should do that. You're going to save on the interest that you would have paid. But what you're going to do is you're going to close the active account, and you've been paying off for 2 or 3 years, and now you're taking that out of the equation on your length of credit history. So you'll save on interest, but you'll lose on points. So that's something I've seen. And one other thing to add to that, student loans. A lot of people don't realize they graduate school and they have like maybe 5 or 10 student loans out there, and they've had it on their credit, and they've had it in deferment for maybe 4 or 5 years or even longer. Well, that's built length of credit history, right? And when they graduate, I don't blame them. They're going to want to consolidate their student loans so they can, make the payment on time and afford it, which, I recommend again. But what will happen is you close those length of credit history. And so you maybe had a 4-year average, but when you consolidate all those, you're starting all over from day one.
Man, I never even thought about that. You come out of college, you really don't have any credit, but you got these student loans that are actually helping your credit. And now you just killed the credit history. Okay. That makes sense. Yes, all right, sir. Man, let's see here. Let's talk about a little bit of credit in the mortgage strategy, all right, let's see here now. Why credit and mortgage should never be, I guess, kind of treated separately? What's your thoughts on that?
What do you mean, Mike? Are you talking about after they get the mortgage?
Well, I mean, not so much after they get it. Just go ahead and say, let me think how, I guess a better way to phrase that. Shoot,
Why
man,
credit and mortgage should never be treated separately?
yeah.
As far as strategy, are you talking about which one should
Well,
be done first?
I guess I can kind of answer that myself, man. I mean, obviously, you want to have the highest credit score as possible because, I mean, now on my side, as the mortgage expert, there is a huge, well, I won't say there's a huge difference, but there is a difference between having a 679 and a 680. Some loans will cut you off at, hey, you don't have a, let's even go down to 660. So say you don't have a 660, you can't do a cash out, or you're going to pay tremendously for having that lower score.
Mm-hmm.
All right. Now and I'll go into this one. Now, some of the credit factors that the lenders do look for is going to be one, the actual score. Two, if you already own a house and say you had a late payment on it, you definitely don't want to have a late payment on your mortgage trying to get a mortgage. They look at that. Obviously, the debt ratio could come into effect, so you definitely don't want to max your credit cards out because, like you just said, having that high balance is going to lower your scores as well. The types of collections and things of that nature. I guess it's kind of talk on that. Are there any particular type of collections that hurt more than the others?
Oh man, and you asked a really good question. Things I run across all the time. I can get a customer that comes that we meet with, and they'll have, like, let's say a $300 utility bill, and then on their credit report they have a $15,000 repo, right? Mm-hmm. Now on the payment status, it goes 30, 60, 90, 120, 150, 180, charge off, collection, repo. Those three, charge off, collection, repo, are all in the same category on the payment status. So whenever we see a repo or a collection, or we see a $300 utility bill, if we won the lottery tonight and we paid off all of our collections, they're all going to still say collections. See what I'm saying? So some people may think that, well, I should probably pay off the bigger one. You should, because there's more debt that's accumulated on there, affecting your debt ratio. But the end result is still going to be a collection. So whether it's a $5 collection or $18,000 collection, the payment history is still the same.
Okay. All right. Now, I'll touch on this. All right. So as far as a lot of people out there would think that, hey, he's having a 700, right? For some reason, that seems to be, people are always talking about, hey, I'm in a 700 club. So a lot of times we get people a call and they're like, hey, I'm in a 700. But we have a thing, it's called loan level pricing adjustments. And you're getting those until you reach 740, right? And so just improving, if you got a 720, but you don't want to pay those adjustments, we need you to get 20 to 40 more points. I mean, that can dramatically change things. I mean, we're talking about your rate, your payment, your approval level, all types of things. So I don't know what it is, but everybody thinks that, hey, I got this 700, so I got great credit. Well, you are good. You're extremely, you're way better than most.
Yes.
And they don't, they kind of get upset sometimes because they see, like, hey, why am I paying this for this rate, or why does this rate cost this? I got good credit. Like, you got good credit, but you don't have good mortgage credit,
Yeah, and I've seen, customers, they came to us and they had 800 and they had one collection, with like $300 medical bill, and they go from 800 down to 700, which is still a good score. They can still get qualifications, but they just won't get the prime rate, because they probably got to be in that threshold over 700 to get, like, prime rate on a vehicle. But the mortgage, like you're saying, 660, 680. Yeah.
Now, while we're on that, right, and for people that's watching this, I don't want you to think, hey, you got to have a 700 to buy a house. I mean, we can go down to 580, right? Preferred 620. Now, there's a lot of people out there that's going to tell you, hey, I can get you approved at 580. We can too, but you're going to have to put down at least 5%. So if you don't have the 5%, they can't get you approved at 580. unless maybe it's a VA, which really doesn't have any credit score requirements, but you still got to come through and the system has to approve you. Now, since we're on that, as far as, man, I had a question in my head, but let me ask you this other one here while I try to remember this other one. Typically, right? How long does it take for someone to quote unquote fix their credit or get it improved? And I know that's probably a question that everybody out there is probably wondering, like, hey, I'm ready to buy a house now. How do I fix my credit? How long is that process going to take?
So on average, 6 to 9 months. Okay, on average, 6 to 9 months. So let's say somebody came to see us and they have just nothing open in their name and they just have some collections. Well, it's going to be a good and bad that they're having to overcome. They have to establish good and then they have to reduce the bad, right? So to establish on the good side, we help them get a secure credit card, or they can be added as an authorized user from a family member. I wouldn't use anybody you don't know. That can create big problems that we've seen. But that's going to be the part that's going to take at least 6 to 9 months to establish, get the benefit of the length of credit history on that new account. So as that's going, the other side of it, the bad, is we have to reduce the collections or the derogatory. So if somebody on average has 10 to 15 items that we've seen, it takes right about 6 to 9 months. When we get into that, I'm sorry, it takes less than 6 months. When we get into the 6 to 9 months, it's because those remaining collections need to work out maybe a payment arrangement to get qualified for a mortgage. Maybe it's a apartment eviction that is on the credit report that still needs to be resolved. So, or we have to negotiate a settlement, a one-time payment where they just pay it off and then they turn it into the underwriting to overcome that criteria. So about 6 months of disputing, and when the disputing process is done and we've gone through every avenue possible, then we'll look at the last resort, settling. We by no means try to tell customers credit repair is going to remove everything. That's one thing we're very transparent on. Credit repair will address everything. We can do that, the credit restoration side of it, but doesn't mean it always comes off. Our success rate is about 80%. So if they have 10 items, they're going to be on average left with 2 items remaining on their credit. When we get to that 6 month, what do we tell the client? What do you want to do? Do you want, our suggestion is you want to address every negative item. That way somebody pulls your credit, there's not going to be a reason why they can give you a higher rate or even not qualify you. So a lot of them are like, yeah, you know, I've gone this far. What do I need to do? Well, let's talk about settling these debts, because we no longer, there's no other option. I'm trying to dispute them. They're 100% accurate. They're not going to be removed, which I strongly suggest to settle it, because the end result would be, yeah, it's showing a collection, but it's a zero balance. That starts the 7-year mark where that can fall off your credit now. If they didn't, they can be resold and put on it for another 7 years, and now you're stuck with the same problem. So it's best to remove as many as possible for inaccuracies. And if it is, there's our remaining items, then we can look at the last option, settling it.
Okay. All right. Now, real quick, you gave me 2 extra questions here. All right. So authorized user accounts, right? And you mentioned, hey, get on with the family member. Now, I have seen a lot of companies out there that people pay to be on folks' credit cards, and then something happens when they go get on this person's credit card that they don't even know, and now they got another bad mark on their credit that's actually not even theirs, and they actually paid for it. So talk about that.
Yeah, and so what happens is the way the authorized user trade lines are being sold, they're regulating that more, which they should.
I guess is that even legal? First of all,
no, it's not. It's not. And so what it is being deceptive to the creditor, the one that's going to grant the credit, that this is really your pay history. And if, you know, when you look at the grand scheme of things, they're basically just using it just to have a score and be deceptive of what their score really is, because they haven't proven their score because it's not in their name. Now, I've suggested that for our clients, that maybe it's a family member, like a wife, a brother, a parent, grandparent, and that's perfectly fine, because that's what they're there for. But when you don't know the person and you're giving them all your information, your social security, your date of birth, I mean, that can lead to all kinds of problems with identity theft and so forth. So I've added my kids to my authorized user card, and I have to know their social to add them on there. I got to know their date of birth. in order to add them I add them through Capital One on my app. So that's what that person that you're buying that trade line ultimately has to do. So why would you leave yourself susceptible over some sort of, I'm not saying that they're all like that, but it could happen. I wouldn't want to do that. But yeah, that's what we refer to our clients to doing it with somebody they know. And the type of trade line has got to be one that's established, right? The second thing is that they don't have a high utilization. I've seen some customers that get added to somebody they don't know, and they're maxing that credit card out and they're lowering their score. So now we got the next challenge of getting that off their credit because that utilization is killing their score.
Yeah. So now you paid some company to put you on somebody's credit card. They ran up their debt, and now you got even a bigger problem because now you got even more debt.
Yes.
But as a tip for people out there, right? Hey, if you got good credit and you got younger kids who's just now establishing themselves,
yeah,
put them on your credit cards as authorized users. I mean, those are your children. They can totally legally be an authorized user and get that history to help them build their credit.
Yeah.
All right, cool.
I've done that, like I said, with my kids. And, if we want to add to that, what we did is as soon as they turn 18, we add them as an authorized user. We got them their own secure credit card. We coached them. This is not for emergency. Let's get that out of our head. My job as a credit counselor is to help you understand, change your way of thinking. Credit cards are not for emergency. A savings account is for emergency. A credit card is only a tool, keyword tool, for you to have good credit and to pay next to nothing on interest and major purchases. It's not for anything else than that. That's what we do, coach our clients and our children whenever we were adding them. So they don't even look at credit cards as using them. They only use them for tools so I can have a great score. So whenever my child turned 18 years, 9 months, we pulled their credit and they were in the high sevens simply by doing those two things.
Yeah. It's funny. I mean, I heard that a lot. Like, hey, I got credit cards for emergencies, I mean, and I get it, some people out here, hey, they don't have the savings. And so, hey, if your car breaks down, you got this credit card over here. Like, all right, man, I got to get my car fixed. So, hey, we got to use it. So, I mean, I kind of get that mindset for the people that do not have the savings. But if you do have it, if you got the money, obviously you don't want to be paying interest on stuff. So, I mean, try not to use the credit cards. One deal you talked on, you hit on the 7-year deal. All right. So you're telling me if it's resold, that the 7 years starts over, or are they doing that illegally? So what I've always thought is it's supposed to go off that original date that it went bad. So the date of the last activity. But if they just keep selling it, does it just stay on your credit forever? How does that work?
Well, it's happening less than what I seen when I first started. It was, there was what was that company where you would buy DVDs? Something House something. They were selling the collection and it was showing up, and the customer would be like, man, I haven't had, that was whenever I bought some DVDs back like 15 years ago.
Columbia House.
Columbia House, yeah. And I don't see it as much anymore. Where it will happen is like on credit cards. You'll see that when it's revolving accounts are sold. So what happens is you may have Midland Credit Management that will buy it from the original creditor, and then they'll sell it to another company if it's removed or the 7 years is getting near. And so that's where we've seen it the most. Now, again, it doesn't happen as much as it used to, but it still does happen. And it's not legal. They can't, the statute of limitations is the 7-year mark on the credit report. And so if they're being resold, then they cannot, because they didn't establish the original account.
Okay. All right. Now, just real quick before we jump into the hybrid program, how can buyers prepare months in advance, right, before shopping for a home? I mean, how can they, what should they do? Like, hey, I'm getting ready to buy a house. I need to make sure my credit's good. How can you help before they go out and do all this other stuff?
So if they go to our website, we have an actual way that they can pull their credit and it won't hurt their credit score. So my recommendation is pull your credit through your own self-credit monitoring company. We have one that we use. It's got a 7-year history mark on it. Most conventional credit monitoring only go back 2 years. Ours goes back 7. It's going to give you a Vantage 3.0 score. And Mike, that's not the same one you are going to pull. You're going to pull a FICO 2, 5, and 4. But understand that that's just an educational score. It's going to give you, I would say about 20 or 40 points higher than what the mortgage score is going to be. But if you can pull your score and see what's on your credit and get an idea, hey, I'm at 700. Well, when Mike pulls your credit, you should be about 650, 660. So just leave that 40-point threshold whenever you pull your credit. Now, if you pull your credit and you see some things, obviously, that are not on there, you do want to start the dispute process as soon as possible. But know this, whether you hire a company like ours or you do it yourself, Mike, you can attest for this, that you cannot have a consumer disputing on your credit report when you go apply, because that'll kick that out on your findings when y'all try to get approval for it. Am I right?
Yeah, that's true. I mean, we get and I get we get people that call in and they're like, man, I've been in credit repair, and my scores are up. And like, okay, are they finished? Because what happens is when you dispute on these credit reports, right? The credit bureaus assume you're telling the truth, right? They're going to assume, hey, none of this stuff is yours. So it kind of removes it from your score model altogether. It almost that score is assuming that, hey, it's not there, it doesn't exist until it's finalized. So if you got disputes on your credit report, I'm going to have to get those disputes removed from the credit report to get the actual true score. And so it happens a lot with, unfortunately, I guess not all credit repair companies are created equal. And so they'll go out and be like, hey man, my score is up, I'm ready to go. And I'm like, well, we got to remove it. And what you thought was 680 is now 580 because all this stuff is basically just in dispute. Now that I don't think it happens with cars. So, I mean, if you're disputing and you go out to buy a car, I think you're good. But on the mortgage side, our underwriting system is going to flag and like, hey, you got all these disputes. I can't give you the correct answer yet.
Yeah. So that's what they'll want to make sure they understand is before they go apply with you. And that's why I like the self-credit monitoring, because you'll be able to see it. It'll be a consumer statement. I use Control F and I type in dispute and I can find all the dispute comments on there. So that would be one thing. The other thing is obviously we talked about already is just if you have a credit card, get that thing down to 0. If you don't have the money, that's okay. Like be on a budget, get on a budget and allocate at least, $100, $50, whatever you can afford to bring that down. Because whenever you go apply, you want to have that higher credit score to get the best rate and get qualified. And of course, be careful with your inquiries. Inquiries they're a big problem that we face. Anything over 6 inquiries starts to ding you more. The way the creditors are looking at, or the scoring model looks at it, is if you're always applying, it's like you're always asking for money. You wouldn't loan money to somebody who's always asking people for money, because the chances of you getting that money back are slim to none. So inquiries, that's what they're there for, is to monitor the consumer and how many times they're applying for credit. So when you're about to apply for a mortgage, anything that somebody's trying to pull your credit for, it could be for, I tell people, even stay away from internet, a new phone, any software, hard pull, just stay away from it, because if they tell you, no, it won't hurt your score, especially like at a dealership, you hear that, it's going to be on your credit report. So just stay away from inquiries. So,
Okay.
Yeah.
All right. So now listen, what I want to talk about here is how the hybrid agent program can help you even with a lower credit. It's better with higher credit, but just say in a lower credit situation, right, where someone goes out there and they tell you, hey, your debt ratio is too high for you to be approved on just your traditional realtor and traditional lender aspect. Well, where my program would come in at, just say, so you're at a 620, right? And say the loan is going to cost you, I don't know, a point and a half or whatever. Right. Well, when I turn around and I give you half of the real estate agent's commission, which in most cases is going to be a point and a half, we just completely wipe that out. Right. So if you're looking at let's just say, I don't know, $300,000 house, right? That point and a half is going to cost you $4,500. I just eliminated that cost for you. Not to mention that you got a lower interest rate, because if we compare apples to apples, if you were willing to pay that point and a half, if you pay that point and a half still and let me cover it, we just brought your rate down. And so what that ends up doing is saving people a lot of money in the long term.
Yeah.
Right now, another deal here, and I've had several clients do that, man. They told us, hey, we couldn't get approved because our debt ratio was high. Actually, one of my first hybrid clients, and actually I've done several deals for the guy. I think I'm on house number 3, 1, 2. Well, I bought the house, sold the house, helped them buy another house. So yeah, this is deal number 3, where they were told by one of the supposed top lenders in our area. I can't name names. They already don't like me, but they were like, "Hey man, your debt ratio is too high." They came to me. I'm like, I have no idea what the hell they're talking about. So put it together. We're out. We went out and bought a house. Right. Just had another one here a couple of months ago. I mean, these buyers, they were looking at older houses just because they thought, hey, we can only afford this. Right. We went to 2 houses, 2 older houses. We walked in. One of them was one of these little flips that's all kind of new, and they put all flashy stuff in there. It looked good, but the street that we drove down, they hated it, right? And just so happens I had been in one neighborhood. I was like, wait a minute, this is a price range, and here's one of the other benefits, right? I'm the lender and the realtor, so I got my laptop with me. I pulled it out and like, let's go. We went and saw a new house. We went to 2 different neighborhoods, saw one in their price range, brand new. You know how everybody loves a new home.
Yeah.
So we showed them that one. It fit their range, closed on it. And the house we were looking at, dude, I didn't want them to buy it. You know, I'm not one of these realtors like, I'll let you buy whatever. Like, this is gonna be a problem later. And I don't want you calling me when it's falling apart. So, but because they were able to use that and strategies that I use with builders to make them give me the same exact incentive, especially these days. So like, hey, we're gonna take that money and we're gonna use my rebate. Now this house is going to be cheaper than the one that you thought you could afford, and it's brand new.
That's awesome.
So
and I've heard a lot of people don't realize the benefit of that one that you said, like 0.5 to 1.5 points, like that they can utilize.
No, see, it's not 0.5 to 1.5. I give them up. I give them half of it, right? Now there's some other people out there who's tried to copy my program, and I only want to give a point. Like, okay, cool. Listen, man, the deal is half, right? We don't get halfway through it, and then I give you less, right? The only time that I have not given half of the commission is when the builder or the seller paid so much that legally I couldn't give any more money because we met the cap. And at that point, hey, it's still a win-win for them. And so once people actually see that, and I mean, I run all the ads and I want people to understand, like, hey, it is a real deal. And so it is 100% legit. People see it. We save a ton of money. And some of the other benefits.
That's real money. Those checks
people look at it like, oh, it sounds too good to be true. Well, I mean, if I'm saving you $400 to $500 a month, that's your car note. Or they let you go back and pay down all the credit card debt. Now you got that money you can put towards your mortgage, pay it down even faster, or save it for your kids, do whatever you want to, but that is a lot of money each and every month. Now, on the other side, for somebody who's thinking, hey, I can only afford this house that's $350, right? And I'm not saying $350 is low. It is what it is. But they may need a lot more house. Say they got 3 or 4 kids, they need more bedrooms. Well, now we use this. Now you can afford that house. And it's saving you, it's still saving you money because now you can afford the bigger home that you thought that you couldn't, simply because you used our hybrid agent program. Not to mention, I mean, working with one person is going to save you a lot of heartache. And I've been on the other side where I was just the lender, and I had to but I worked with the actual real estate agent, and the clients would ask me questions about, hey, well, what's this mean? Hey, call your realtor. But they get frustrated of, well, you're supposed to know that. Well, I do know it, but I'm not your realtor. So when you're working with one person is controlling pretty much all of it. All your questions get answered. And my clients love that. They text me, they call me, hey, what's this? All right, hey, I got the answer. Cool.
Oh, that's awesome. And I hope that people realize, and I know your challenge is conveying in what your benefit is, just like mine or any other business. But, you know, I can honestly speak for what you do. Like, there's no doubt that that's a great program. My family, my friends, even myself, if I had an option of using hybrid, I'm going to refer them to you, because that benefit of being able to use that, some of the commissions to benefit them, like what are they missing? You know what I mean? It's exceptional. That's exceptional benefit.
Yeah.
So
All right. So tell me this, man. Tell me your biggest success story with
mm.
one of your credit counseling clients.
Oh man, I got many, but I got one that's, well, let me give you two, right? All right, so I had back in Lubbock, we had this kid. His dad went through our program and bought a house, and the kid who was 17 years old, as soon as he had turned 18, he wasn't even old enough to buy a beer. So when he was 18 years old, he purchased his home while he was in college. So it was a small starter home, but it was, I want to say, priced less than 100. I can't remember the exact amount, but the kid was working, so he was able to establish his work history. His credit score was good. His dad helped gifted him the down payment, and man, that just really like opened my eyes to the possibility that even if an 18-year-old can buy a home, why are we not as adults looking at the possibilities? And also set the bar high is, my girlfriend's daughter and we just had a conversation. She just got a job out of town. She'll be moving. And we talked about like, what are her options, buying a renting, which, that's still a possibility, or buying. So I wanted to introduce her to the benefits of buying and how she could, sell it after 3 years and she'd build equity, or she can rent it out and have enough, extra income to pay off the mortgage, but also reduce the principal. Like there's many benefits. So that set the bar high is like, we got to stop thinking small. We got to start thinking bigger. The other success story is, it was a man in West Texas where, he didn't have, he never owned a home. He always faced many different challenges with his credit. He had child support that he had to, pay. So in his mindset that he could barely get by, much less think about buying a home. And what we realized when he was in our program is he was paying ridiculous interest rates on his truck, on multiple trucks, made great money, but always had more money, about the same money going out as he had coming in. So we put him on our program and we coached him on what to do, stop using these cards, stop doing this and that. Well, lo and behold, he was able to get his credit score up higher. He was able to understand that he doesn't need those credit cards. He was saving his income tax and putting it away in a savings for emergency. And he followed the program through and through, and he bought him his first home. And his vehicles, we were able to refinance and get him at that high 20% interest rate and put him on, I think at the time it was about 7 or 8, which is still fairly decent even today. And he saved a lot of money on that, and he stopped co-signing for people, all that stuff. His credit scores, as it sits today, I met with him a few months ago. He's near about 830. He started a business. He's been a homeowner, and man, he's my success story I love because he showed real gratitude of how his mindset was. I didn't think I could be in this situation with all the things I was having to be responsible for. So.
Okay. All right, man. So tell people how they can get in contact with you. I see you got your QR code on here, but for the people that are watching this on their phone, they can't take a picture of it. So how can they connect with you?
I can go to mrcreditsolutions.com, or our new domain is mrcredit.solutions. There's a new enrollment process they have to go through. They can't call us, unfortunately, because there's a new TSR compliance that we follow. And that means that you have to go through an online enrollment before you talk to a credit counselor. So if you're thinking about using a credit counseling company, make sure that they are following the TSR compliance. Many aren't, and I'm not here to bash other companies, but it's something that we take pride in. We want to make sure that we're following what the government has for us, the FTC and so forth. But they can go to our website and they can do the enrollment process, and we'd love to speak with them. We'd love to go over their budget. We'd love to go over their goals and how we can game plan and put them on that path.
Okay. Now, cool. Now, real quick, man, I'm just going to tell the people out there that are probably needing your services, finish the program. Like, listen, man, it's a lot of times we'll get started with people and people get frustrated or they're in it for 2 to 3 months. I want people to understand, like, listen, man, your credit didn't get bad or affected overnight. So it's going to take some time to fix it. And listen, I'm one to attest. Listen, I've had great credit. I've had bad credit. and I had great credit again. So I've been there. It's not a situation to try and bash people or anything, but it's going to take a little bit of time. The biggest deal for myself, and once I got good credit, is I fixed a habit, of, hey, I don't need the new shoes or the new car or the new code or the trip every other month. At some point, we got to figure out, hey, what's more important? Is it going to be, hey, I got good credit and I want to keep it? At this point in my life, I can go into, and this isn't a brag, but I used to be the person that I go to the dealership and got nervous. Like, crap, man. I don't know if I'm gonna get approved. I'm gonna be embarrassed. Everybody's gonna know. That sucked. And now I go to the dealership. Hey, here's the loan. Here's the car. Here's the price I'm willing to pay. You want it? Yes or no? And so, that's a good position to be in when you know you're going to be approved. So credit is extremely important, not for just homes, but cars, insurance, everything these days.
Yeah. Oh man, it is. And I'm glad you said that, because even myself, guys, like I was there, and I even had a hiccup not too long ago with some new collection that showed up. Wasn't mine. And it's a process, like Mike was saying, it took me almost 9 months to get those stupid 3 collections off my credit report, because how many Chris Rodriguez's are there? There's many. So that name crossed to my credit report, and me being the owner of the company, I couldn't get it off my credit in like a month or a week. So the whole fantasy, like, it can get done quick, it can't. And the reason why the Bureau is going to put up a fight, they're going to put it through their Oscar machine, is send you a generic response. They're not really going to investigate. I mean, we have to keep fighting it and escalating it in order to prove our case. And that's the reason why it takes time. We want it to happen overnight. Trust me, nobody wants to be more done with your credit than we do. But the reality of it, it's not going to happen that way, even for myself, like I just said. So just be patient, focus on what you can do, not use credit cards, not apply for nothing. Start, on your budget to save. You can focus on those. We can focus on addressing the negative items by removal for inaccuracies, or settling if they can't be removed, to help you get qualified. So,
okay. All right. And so for myself, hey, if you guys out there, you're looking to get approved or pre-approved, go to hybridagenthomes.com. You can search for homes on that site. Now, the beauty of the site is I got the rebate plastered super big once you actually get into the houses, once you look at it. The problem is none of y'all look at it. Everybody's just so excited about looking at houses. They just big banner at the top, like, hey, I'm going to give you $8,000 towards your closing costs. Everybody skips it. It's important, people. It's up there for a reason. So if you want to save yourself a ton of money, man, check out the Hybrid Agent program. It's not a joke. It's not a game. It's definitely not a scam. There's several people walking around Dallas paying $400 to $500 less than what they should have been paying, and they're saving money. So if you're thinking about buying, you definitely want to take advantage of that program for sure. So if you don't have anything else, man, we can wrap this up, but I appreciate you coming on. This actually went pretty smooth.
No, I like it. It was our first time, ladies and gentlemen. We're a little bit nervous. We're getting situated, but I do look forward to maybe we can do touch on some other subjects. I was just, when we were talking, I was thinking, like, man, we should talk about the different types of FICO scores in another segment, and talk and address, like, people always confused. Why is my credit score not the same when my loan officer or whatever pulls it? We can dive deep.
I mean, we're here. Let's go ahead and tackle it. We're on credit. We got about 5 minutes left. Tell us the difference between.
No, I have another appointment coming up, Mike, so we'll have to save for another time.
Okay. So, all right, man. All right, man. Guys. I appreciate you coming on. Let's
Hey guys, one other thing, if y'all have any comments or any questions, go on the page and put the comment in there, things that y'all might want us to talk about. There's many different things to talk about. So maybe, we can open that up for that, Mike, to give us an idea of what people really want help with or want to know.
All right, cool. Definitely. Yeah. Leave comments in the comment section. Subscribe to the channel. You got a YouTube channel?
Yes, sir.
All right.
So Solutions, and we'll put it on there. So
so shoot me your channel link, man. We'll link to that too. Matter of fact, I'll shoot you the deal. You can post this on your page also. We'll just do it like that.
All righty.
All right, cool, man. I appreciate it.
All right, Mike. We'll talk to you soon.
All right, later.